Investing Insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
Well, good everyone. Welcome to Investing Insights with the Right Property Group. I'm your co-host, Phil Tarrant. I'm joined by my regular co-hosts, and they're both equal. Often one may be more functional given any given day than the other, but I'm going to introduce them backwards this time around. Victor Kumar is already laughing from the Right Property Group, and Steve Waters.
I don't even know where you're going with that.
Really?
Dysfunctional?
Dysfunctional.
That's right. I'll take it.
It's
I
dysfunctional.
think what's really happened is
It's
thrown
dysfunctional.
him. It's thrown him that we've changed positions, right? So
Well, not really. It's dysfunctional because there's a nice segue into how dysfunctional the state of the world is right now in terms of our government and what's happening, Stephen.
See, that's
happening
good. That's
right
good.
now in this great land called Australia.
Is that a question?
Well, you know, we're recording this. It's the middle of April. You're going to be tuning into this in about a couple of days' time. Lots going on. This election stuff. I've been reading the paper recently, as you do as well, and there's all this stuff about numbers and incorrect budgeting and modelling and forecasting when it comes to negative gearing. I don't think anyone knows what's going on. I saw the shadow treasurer down there at the press club in Canberra getting absolutely bollocking from the journalist, and he was defending his position. I don't know who to believe anymore.
Well,
What do you think,
it
Steve?
was a great answer. He answered it without answering it. He went all
He's a
around.
politician.
Well, they're very good at that. But there is some concern around the market. There's concern around the budgetary figures. Look, where do you start with this? It's already been well documented and reported on about the projections and how they're not quite accurate or potentially not accurate. But I think if we just drill back and let's just see how that affects the average investor, will it affect them? How it will affect them? And potentially, should you actually change your whole strategy around potentially what could or could not happen?
Right, let's have a chat about this because I'm sick of talking about this personally, but I think we're going to be talking about it for the next 6 weeks at least until the election.
And I think a lot longer than that.
A lot longer after. So elections, what do we know? Okay, we know elections been called, that we know. We know that the coalition government has handed out its budget, which it did 2 weeks ago. We know that is now officially the election campaigning period where everyone's out there and banging a drum and on their buses and planes, travelling the breadth of this land, talking about their policies. So we know a lot about this sort of stuff, right? We know as property investors that negative gearing is going to be a key issue, which is going to shape the way in which Australia votes in 6 weeks' time, call it. So I'm a voter. Which way I vote is no one else's business, and I'm completely neutral when it comes to discussing this sort of stuff on a podcast. But you know, we're talking a lot about it. I think we'll talk about it today because I think everyone needs to know, and I know the good people that listen to Investing Insights of the Right Property Group have probably got this in front of mind. The way I frame this, Steve, is that I go, all right, well, it's all this stuff I do know, but none of it I really can control. And someone's going to say it's a democracy, you can vote, and you've got the right to vote, and yes, that's true. But as a property investor, should I be changing the way in which I view my investment strategy based on what might happen come the middle of May when there's election? That's the question. Let's deal with that.
That's a great question, but short answer is no, because if you had the strategy right to begin with, well, then this is not so much business as usual, but it certainly isn't going to be a black and white polar opposite scenario where you should just pivot and go in a total different direction. You know, as all good advisors will tell you, that the whole gearing scenario and tax minimisation isn't the strategy. We've heard that a million times. But to be fair, for us, the reason that we target and invest in the price brackets we do is because potentially they give us a better yield than perhaps the more expensive properties, and that gives us survivability, the ability to pay our mortgages and then have a greater period of time without affecting our lifestyle.
I actually, you have thrown me because you guys have changed position in the studio. It's all a bit strange, but
I'm not liking it to saying.
Let's go back to 101, Victor. For our listeners who have just found this podcast, and I think you must be under a rock if you haven't heard about negative gearing over the last sort of 3-4 months as we gear up lecture. You must be under a rock if you don't actually understand there's fluctuations in the property market right now. But anyway, let's talk about negative gearing. And Steve just said negative gearing is not a strategy. Mm-hmm. We'll deal with that, right? But I completely agree with it. But what is negative gearing, Victor?
Well, essentially, you are claiming the loss against a property. So your expenses, such as your interest components, such as your depreciation, such as your repairs and maintenance, you're claiming against the income. So you're offsetting the income against the expenses or vice versa. And in doing so, provided you have already paid tax. So if you're a PAYG, you've had tax withheld, you are claiming that back from the government. Now that was and has been a incentive, if I can use that word, by the government for many moons. We did tinker with it back in the 80s. That didn't end quite well because it had a flow-on effect of not only impacting just the property investors, but also the general economy as well. And that is the by far the biggest fear out there, because we don't have any real clarity in terms of how and when they're going to bring this in what form. They did say that this is the Labor Party, that they will look at it when they're in government on the 1st of January to bring this in.
2020.
Yeah. And also that they would target more the multiple property holders in Australia. And therein lies the problem, right? Because when you look at property investors, about 1.8 million own one investment property. And they are your mum and dad investors. And I say that in the most respectful way possible, because what you have is most people trying to actually build towards their retirement so that they're not reliant on the government. Then the next band is only 400,000 people that own 2 properties. And when you fast track it to 5 to 6 properties, you're really only talking about 20,000 odd investors. So the reality is that in the way they're touting it, it's probably going to impact directly your 20-odd thousand investors, which is directly from the ATL stats that was just released for the 2016-17
Well, very good memory, Victor, because I've just pulled that spreadsheet up in front of me here, and there is 20,357,000 Australians that own 6 or more properties, which represents 0.08% of the population.
Correct.
Tiny.
Very tiny, yeah. So there's a lot of hoo-ha about this, in my opinion. The reality is that the people that already own an investment property, they will continue with their negative gearing because it'll be most likely be grandfathered.
Quarantined, yeah.
Quarantined. People that are going to then invest between election results and 1st of January, likely that there may be a spike in the property market because everyone will start jumping in, trying to get in ahead of the change, which will then financially hurt a lot of people as well, because those same properties will then slide backwards when the flow-on effect happens. So let's say I've bought a property, I can negative gear it, but if I'm trying to sell it, let's say my circumstances change and I'm trying to sell it.
Incentive isn't there.
Yeah, the incentive isn't there. The aftermarket will drop, and that's where the real pain will be for people that are focusing on negative gearing. And we've been on record, Steve and I have been on record to say that negative gearing in itself, the tax consequences, the tax side of property investing is just a moment in time. It's not the strategy. The strategy is the wealth creation. The strategy is getting to the income of the property. And if you've set up the strategy correctly right from the beginning, this, as I've always been saying, tax is always a sovereign risk. So government change.
So you mentioned just how potentially this could be as big as everybody thinks it'll be. So to give some context around that, and the Australian residential real estate market total value is $7.5 trillion.
That's the collective value of all the property.
Yeah. Now that's massive, yeah?
This is just the residential.
Now the next closest thing to that is Australian superannuation at $2.7 trillion. Australian listed securities at $1.8 trillion. Now there's daylight between Australian residential real estate and the next most valuable vehicle that there is. I truly, whilst we can talk about the numbers, while we can talk about the consequences and everything else that goes along with gearing, what hasn't really been talked about, that every single person in Australia, with zero exception, will be affected in one way, shape or form. From the person folding paper clips in the factory, or through to the people that live on Wolseley Road, Point Piper, everyone will be touched by potential changes. And that's not talked about enough. And whether that be through increased rents as the years roll out, whether that be via a contraction in the value of people's properties. Now, forget property investors, even just the person who has an owner-occupied property, and the consequences of that via the wealth effect and spending within the economy and so on and so forth. So I think this is actually larger than just the figures. This is about potentially pushing Australia into a recession.
And this is what some of the commentators are saying,
people's
right?
understanding of a recession is also a little bit skewed as well. It's not a depression. It's not a GFC. It's just 2 consecutive quarters of negative growth. And whilst it sounds really, really bad, there are tools that the government have and the banking systems have to perhaps arrest that. But this certainly isn't going to help.
Well, it comes back to the wealth. You're talking about the impact of the collective sort of economic ecosystem, that every single person in some way or another will be impacted. If owner-occupiers' wealth in their properties decreases, that means they've got less equity. That's less equity they can use to refinance and use for other purpose, or buy flat screen TVs, or buy new cars, or whatever, right? It's cheap debt in your mortgage compared to personal loans and this sort of stuff. So the whole of the economy will be impacted as a result of this. But, to go back to our original comments, Bowen, the Shadow Treasurer, seemed pretty confident in a commentary I saw coming out of him from the National Press Club speech that we've got some of the smartest people in the land are doing this modelling.
I saw that.
That's where his basis is. The smartest people in Australia have done the modelling, and therefore it is correct. Now, and I saw him backflip a little bit, going, "Oh, it might not be 95, it might be 86." Was it the Grattan or Garton Institute?
Yeah.
So he goes, "You know what? That's pretty much what it is." And I sort of went, "Oh, yeah."
But you know what he was? My opinion of that was he was just giving himself an out for potentially 12 months' time.
That's right.
Well, I relied upon the smartest people in the world, and they misinformed me.
And he's got some smart people helping him out, right? They're smart people. There's some very, very bright people.
But there's been zero interaction with
the property investors,
with the housing industry. Like really, like you want to talk about the smartest people in the world. Maybe not the smartest people in the world, but certainly the people.
Definitely not in this room. Present company excluded,
of course.
Sorry,
but then as some have pointed out, the numbers perhaps don't lie, but I think having an understanding of the numbers and how you actually came to those numbers to begin with is where the issue is, because you will have 10 sets of eyes on something and everyone will have a different opinion. Everyone. And his is just one that happens to...
Economic modelling, right? Things change. But can I just pick up something that you said, Victor? And I think...
I hate that term, modelling. Yeah, I really do, because it's forecasting potentially the unforecastable.
Yeah, it's hard, but you need somewhere to start from, right?
I believe you need a position.
Yeah.
But there's I'm not going to get on that soapbox.
Oh, here we go. No, so what you said, Victor, and I think is really important. We're talking about the secondary market of new build property. So from what you said, the way I framed it is that if the negative gearing tax incentives are still connected with brand new properties, that's cool. So it means that more people are going to be buying new because of the perceived benefits or outcomes through negative gearing. What you're saying, though, is that no one will want to buy those properties on the secondary market because those benefits just aren't there, which means that you're going to have a whole bunch of people with properties that they can't sell, can't offload, can't realise the value in, and that's going to really slow down building and other sort of parts of the economy. Is that pretty much what you're getting at?
Yeah, let's play this out a little bit more, right? So let's say someone bought a brand new property, and let's say it was 500,000, and with tax incentives, they're able to afford to hold on to it. Their circumstances change, and they have to sell. There's only two parties that could buy it of him. One, who's earning a high enough income to afford the negative cash flow that property is going to bring. Or secondly, it could be a person that's looking purely for yield and therefore price point, and maybe buying that property of him for, and I'm just making these numbers up, maybe buying that property of him for 400 to give himself perhaps a 6% yield when your interest rates are at 4.5, as an example, right? So you've got these two very distinct buyers. The system that they're proposing to bring in is supposedly to help the battlers get into their first property, right? But the reality of it is the aftermarket is going to tilt substantially in favor of someone that's on a high income, which is what they're trying to prevent, so that they don't want to subsidize their fifth or sixth property, if I follow the rhetoric. But the reality is that that's exactly what's going to happen. They're going to subsidize it by way of actually killing that market.
Has anyone bought into this debate the fact that Australia's property investors actually provide a key component of living to a lot of Australians, that is housing, right? I look at the portfolio that I have. They're in, to use your terms, they're not really battler belts, but, just in like
Mortgage belts.
Mortgage belts, Australia. Right. If investors come out of the market because of these incentives are removed, is the government going to have to start paying and buying and building a lot more housing for Australians?
Well, that's what they're trying to get out of right now. So the whole government housing commission model has not worked for them, whether it be from a cost of repairs and maintenance, whether it be the way that they grouped everybody together. It just clearly hasn't worked, and they're the first to admit that. If they don't want to do that because it's too expensive for them to operate, then who's going to supply the housing is the question. Perhaps they think that people are going to become, instead of being renters, they're going to become owner-occupiers because things are more affordable. It's not
People
that
can't get
easy.
mortgages, though.
Well, that was my next point, right? So it can be as cheap as as you want it to be, or however cheap it is. But if you can't get a mortgage, you can't get a mortgage.
Yeah. And this is the biggest problem with most people. They can't save. There's probably two things. Most people, if they work hard and they've got a regular income and PAYG, you probably get a mortgage, right? The issue is saving the deposit in order to get a mortgage, and that's a completely different thing as well. But what's your thoughts, Victor, on these schemes? Because an argument would be, well, we now have these schemes where we build affordable housing in there's areas, pockets within particular suburbs that property investors can buy. And you might be buying, a two-bedroom apartment here versus a two-bedroom apartment next door might be $200,000 in difference, allowing you to them to facilitate this sort of stuff. What do you think of them as investments?
Look,
because this goes back to changing your strategy,
it
right?
does come back to changing strategies. And if I look at it from a historical point of view, in the Paul Keating days when negative gearing was tinkered with, the very first thing that happened was that the rent started moving up, right? And that had brought that negative gearing, do away with negative gearing at that time to help the first-time buyers get into property. It was the rhetoric back then. But they couldn't save money because they had to pay more and more funds towards renting the property. So it had the opposite of the desired effect. And certainly, when there's change afoot, obviously there are opportunities around in terms of different schemes that come out, whether they're government incentive schemes or whether they are things that property investors get together and do creatively. So there will be some changes that will happen, most likely, and schemes such as getting low-cost housing and all of this, those sort of things will become prevalent. But at the end of the day, the fundamentals are being tinkered with in terms of the general economy itself, which is very dangerous. And if you look at it historically again, they did bring back the negative gearing after 2.5 years. The very first thing that happened was all of that losses that was quarantined got claimed by the property investors pretty much in that same year.
Yeah.
And that pretty
broke
much
the system.
that broke the system.
Can you just explain that dynamic of rents increasing? So this is, I guess, basic supply and demand. I look at some of the properties I have out in Sydney, and rents have dropped from when I secured those properties sort of 5 years ago or so, right? And one of the reasons for that was that there's a whole bunch of other property investors buying in the same area.
Correct.
Look, I've done great in a capital growth play because I've bought really well with your guys' support, obviously. But there was a whole bunch of properties on the market, therefore there was less pressure, less upward pressure on rents, and therefore rents come right back, right? So
That's supply, though.
this is supply, right?
Yeah.
So flip it on the other side. If you have less investors in the market because there is a removal of benefits around or a change to tax policy, less investors means less properties. That means landlords can put the rents up because traditionally people just go, it's too expensive, I'm going to move to the place next door.
Exactly.
But now they're not going to do it. So that will naturally force quite quickly rents up because property
true.
investors are going to go, I've got to sort my yield out because I'm not getting the benefits.
But we're forgetting a major contributing factor here, and that is new dwelling starts. Like that, people.
But they reckon those numbers are skewed, right? They've been high recently.
They are high, but they've come off up to 25% new building starts. Now, admittedly, there is still stuff in the pipeline that's in the midst of construction, but once that stops, the new building starts and the DA approvals is just fallen through the floor. This will have a direct outcome on supply because no one's building, and no one's building because no one's got the confidence to buy, and they can't get finance, and we've got a broken lending system apparently as well. So This will just add fuel to the fire in terms of increasing rent supply. Admittedly, not across every state and territory of Australia, I believe, or every suburb. But if you took Sydney as an example, which has probably had the biggest boom, and it's probably come off the biggest in terms as well, and its new start dwellings has also fallen the most as well. But if you just look at it geographically, and I think we spoke about this on the last podcast, we're bound by sea, mountains and national parks. We do have a limited supply of land, and Sydney's one of those only places that really do.
Still a lot left to build on, though.
There's still a lot. Well, that depends if they change zoning.
Yeah, true.
Yeah, and this is it's another spoke in the wheel, I suppose. But if the dwellings aren't completed, if they're not DA approved, if they're not constructed, then rents will go up. That's an overlay on top of what you were just talking about, right, Vic, as well. And let's not forget that to get a DA approval, start turning dirt and have something door ready. It's not an overnight. Yeah. It's not an overnight thing. And this is exactly what happened in the affordable corridors post GFC before.
Okay, but you have your state government trying to make it harder for planning and development, right? Because of some of the challenges you've had with. Correct. Another issue to this, the fact that the quality of the developments which have been taking place, there is a lot of question around. And around those, like Opal Towers brought it all to the fore.
And I agree 100%. And because we do this every day and we're fortunate enough to see so many thousands and thousands of properties every year, I've noticed personally just in the last 14 years specifically, just the quality of construction has gone backwards at a rate.
Yeah, I agree. Absolutely, it has.
There are some buildings that
should never have been approved.
Well, I don't know how you can stand at the bottom, like walk-up units as an example. You can stand at the outside the bottom floor, look up the external wall, and it's like a banana. Like you can't miss that. Yet that was still approved. So the quality of construction is another issue, and therefore the cost to repair it as well.
So this goes back to so as a property investor, there's all this stuff going on, and we've spoken about 4 or 5 reasonably complicated and also interconnected sort of issues there. And I go, okay, what do I do about this? Should I change my strategy as a result of it? Now, I step back a second and I think, you know what? If rents go up, okay, I've got an established portfolio. It's there already. So let's say I'm not buying. If rents go up, it's not a bad thing, right? Because I get the benefits that increase my yield play. Everything's grandfathered anyway, so I still get the benefits of negative gearing and I have less investors in the market, so I could probably cherry pick better properties. And you're in a property market right now, we're talking about Sydney and Melbourne, which some people are starting to call is sort of towards the bottom. And you've also got noise come out of the lenders that their appetite for lending is starting to change a little bit. So I go, that's actually not a bad time to be a property investor. I don't need to do anything. My strategy is sound. I should just do more of what I'm doing right now and try and cherry pick those properties.
Look, I agree. One person's risk is another person's opportunity. And this particular market, whilst we may have changes afoot, things don't change for me personally as an investor. I still stick to my own strategy, which is about growth and cash flow. And I say cash flow last not because it's the most important, but perhaps in the next couple of years it will be. And I will look for value.
So if I look at it from the opposite side, right, to say that, okay, I am an investor. I'm quite comfortable with the changes that are happening, right? I'm not worried about the negative gearing because I can, instead of being able to afford 4 properties, I can afford to hold 2 properties. I would say bring it on. And the reason why I say bring it on is purely simple, right? If you look at it from a viewpoint that it's going to come in, it'll hurt for the first 2, maybe 3 years, and then normalcy will set in because that's what we'll get used to. Every time there's change, there's always this upheaval and the wealth gets redistributed. It'll get redistributed to people that are prepared. It'll get redistributed to people that can afford to hold on. Those that can afford to hold on will then really benefit from the fruits of their labor, no pun intended, of getting that higher rental income. And the yields will significantly increase. So you only need to go back to the GFC. The prices were coming back significantly. Loans were expensive to get into, and the rent started going up significantly. And we started to see your 7% and 8% yields in Sydney,
correct.
Right? And if this did happen in terms of negative gearing being abolished, there's quite a strong chance that we would see that market again, where it is man-made in terms of government man-made, so that the market conditions become very much similar to just post-GFC, where you've got high-yielding properties in metropolitan areas with the potential for growth, because then when the yields get high, people are willing to pay more money for it, and that's when the growth really starts happening again. So if we get prepared for this, if we prepare our portfolio, if we prepare our psyche for this imminent change, like we've said all along, be cashed up for the opportunity.
Be liquid. We've
absolutely.
said that for many, many years. I just think that whilst it will affect a lot of people, and
It'll hurt a lot of people.
it'll hurt a lot of people as well, if your strategy is short term, well, then this could be an issue for you.
That's right. Yeah.
If your strategy's 15, 20 years, as it should be, well, then this is just potentially something else that you need to manage in terms of not just your psyche, but your cash flow as well, and still preparing yourself for 10 years, for 15 years in that property, because at the end of the day, it's a basic necessity of life, food and shelter. That's not going away.
So if we fast forward 15 years, say even 20 years, and we're the guys and girls sort of beating our chests going, geez, we were smart.
Told you so.
Back there in 2019. What a great time. I wish we had that same period again, because it was a once in a generational opportunity, once in a lifetime opportunity. Whether or not it's going to hold true, I don't know, but I'm sure, fortune favours the bold and the prepared, right? So, to Victor's point, if you've actually got your stuff sorted out, you can probably do well in this market. So 20 years' time, what are people going to be talking about what they did well in 2019, 2020 in this period of...
God, here's some modelling.
Lowest interest rates
Yep.
in many years, a government state of flux, tax policy in a state of flux, property markets in a state of flux, by and large, reasonably strong and confident Australian economy. The economy is not stuffed by any means, right? It's reasonably stable.
Increasing population. Lots of infrastructure going
Lots
in.
of infrastructure.
Massive
You don't have to, go anywhere now. There's buildings anywhere. It's mad. So stuff's happening. So what are the 2 or 3 things that people have got absolutely right, Victor, when they look forward 20 years?
Well, it comes back to the asset selection itself, in where you're buying, what you're buying, and what you're buying for, right? So is it, in today's market, is it to capitalize on the tax incentives that is there right now? Or is it actually to forward think it and go into true wealth creation, go into true cash flow management, knowing that you're investing with the right metrics, where you're not taking into account the tax benefits, because that could change overnight. Even if it does not change in this election, it could be that the next election, Liberals come up and say, you know what, we're going to do away with the negative gearing. That can happen. It's a sovereign risk. So we should always be investing based on purely on location, on what the property can do for us, and what plans we have for that property.
All right, let's talk about locations then, Stephen. I know you're going to give me absolutely nothing, but based on what Victor has said, these the current state of play for the objective of creating long-term wealth through property, through good asset selection, which generates a reasonable yield for you to hold property over the long term, irrespective of what the government does to tax policy, where should you be buying?
Where the majority of the population lives and where they're going to live, and that might be based on infrastructure as well. So
that's a really simple way, sophisticated but simple way to look at it. Buy where people want to live.
Yeah, I mean, and I think this is the problem.
Yeah.
People
Don't make it too complicated.
Yeah, people tend to overcomplicate things, and you can sound really smart being pessimistic, or you can just break it down to its basics, and that is as basic as it gets.
Buy where people are going to live now and in the future, where people are spending money to make people's life more livable,
and where the work is.
And where the work is.
Yeah, so let's explore that comment a bit more, right? Why would we want to buy there? The main thing is the liquidity. Liquidity in terms of banks are willing to lend money there because there are people there. There's infrastructure.
Not a lot of restrictions.
Yeah. There is liquidity in terms of rentals because people are moving into that area because there's jobs. And if you ever did want to sell that property, people want to live in that area, so people will buy those properties off you. So you're addressing the liquidity of the property. Obviously, you've got to buy it. Make sure you're buying a house in an area that's predominantly houses, buy a unit in areas that are predominantly units, because that's what people want in there. So we're addressing that end play right in the beginning to make sure that whatever we're getting into, we can actually get out of as well.
So this is a big part of your own personal investment philosophy, Victor, and also the way in which you act as a professional recommending other Australians on how to invest, right?
Yeah, absolutely.
This is brass tacks, that's what it is.
Yes. Very easy to get in, substantially harder to get out of property. So you got to look at how you're going to get out of it first.
I think we also need to understand, though, that not everybody has the same risk profile and not everybody has the same income. And so people should invest accordingly as well. Not everybody's going to invest in Point Piper or Toorak, but for us, our strategy is around affordability because it lets us sleep at night. It puts up some mitigation or defence, if you will, around our position. And at the end of the day, that's the greatest and the biggest slice of the market in terms of people where they want to live because the infrastructure's there.
Yeah, so this conversation kicked off with all this stuff's going on. Should I change my strategy, right? No, how long? I've probably known you guys for 7 years. No, maybe 8 years now.
8 years.
And by and large, your strategy hasn't deviated. You know, it might have left or right a degree either side of it, but you know, if you think about your strategy as a linear strategy, hasn't changed all the time I've known you. Because
this is probably version or cycle 3 of a major economy shift, and things just keep repeating itself. Admittedly, the triggers are quite often different.
Yeah.
But the outcomes are usually the same.
So if you guys are sitting there having a beer and completely off the record, just talking about stuff, you know, is there anything, have you ever sort of sat there and going, oh, maybe this isn't right, maybe the strategy isn't sound, maybe we need to realign, readjust, or is it just is and you haven't?
When we go into certain areas.
Are there any pigeons involved in this conversation?
No, not this time around.
No. Tune into the last podcast. But
I reckon it's probably more like you guys drinking some fine Chateau Lafite sort of in a poshest restaurant in town, smoking your cigars.
And, no, not likely. Too tight for that. Look, do we have that conversation when we're researching an area and we're spending a lot of time on the ground? Sometimes we'll just say, you know what, the data points us in this direction, as we've talked about before, but we still think it's a ways off, and we pull the pin and we're out.
All right.
So, but it's never about the strategy; it's about the area.
About the area, it's about the location, about the individual assets, I guess.
Yeah, we're confident in our strategy, and we're not saying our strategy is the only strategy. It just suits us. Let's just sleep at night.
That's fine. And houses, units in this current market, does it matter?
Doesn't really matter.
No. If it was Sydney, I'd say no.
Yeah, houses. Sydney.
Houses.
Yeah, certainly houses in Sydney, and I think units always have a time and a place because they're usually around better yield. They're usually located on better infrastructure, so they're on the stations, they're on the shops, they're in the transport hubs, and they certainly appeal to a certain demographic. But in today's market, I would say no to
land content first.
Yeah, land content.
Yeah. But having said that, if we were to get a unit 50% of its price, of course
I'm into
you jump on it.
Yeah.
As long as it was in the right place. Yeah. And you asked a question earlier on, of which I kind of dodged about, where, and I just said, wherever the population's going to be. And you also mentioned something about some people are calling Sydney and potentially Melbourne at the bottom, and perhaps going sideways or even having a small uplift. I think we'll see that if Labor get in, just as Victor mentioned earlier on.
Could be a dead cat bounce though,
Oh, well, it will be. It will be. Yeah. But I still think some of these areas, including Brisbane, including WA, including Sydney and what have you, that in between all the nonsense is some pretty good value.
Yeah.
Doesn't mean across the board. We mentioned one piece of good value last podcast, and we've got a few more since then. I just think it comes down to people's capital, how they're starting, their household budgets, what cash flow have they got left over at the end of the week, and that should point them in the right direction.
I think also, with all this uncertainty right now, a lot of people might be sitting in the wings. I think about my own personal circumstances, and I guess the philosophy that we probably both share, all of us share when it comes to investing. You invest when you can invest, because you're never ever going to get the perfect climate which ticks all your boxes. So I'm currently in the process of buying in the Sydney market now. Am I buying, when there's still some negative growth in there? Maybe.
And sentiment, but there's a purpose.
There's a purpose.
And there's a reason for that property to join your portfolio, and that's the way it is.
Yeah. And over time, it's going to be a good performer. When I buy it, I might share where it is. So I don't want everyone buying out that area.
He wants to perpetuate the market. Phil Tarrant bought in.
Yeah. I actually want to buy more out that way first. But hey, just real specific stuff before we move on to our question of the month. Talk about infrastructure growth and all this sort of stuff. I was out there the other day, and it's where you're
northwest,
the northwest with the train station. Is the train working yet?
No, they're doing testing it. Yeah, they're testing it.
So have you seen any difference? Because that's a huge, that whole thoroughfare of there's probably from sort of Castle Hill way right out through
Rouse
out
Hill,
west, Rouse Hill. There's like, probably 3 or 4 new suburbs getting built, really, or new town centres and stuff, or supplementing it. What do you reckon out there? You reckon like over time it's going to be a real boon, or is it going to be
over time? It will be for sure, but it's already had its moment in the sun during the boom we've just had. It had tremendous growth. A lot of the house and land package opened up because it's some of the last vacant land really in the Sydney corridor, and so it went very, very well. Grew a lot, also on the back of the infrastructure, but it's also got one of the highest vacancy rates now as the market comes back, and it's had some pretty big drops.
Heaps of units getting built.
It's not a unit. Yeah, it's not a unit market. I just think that's crazy town planning.
Mate, they're building so many units.
Yeah.
If you're driving west on the left-hand side, it's Windsor Road, isn't it?
Correct.
Yeah, there's like huge blocks of I don't know, probably 500 units.
Yeah, it's wrong. Eventually that will infill, and it'll be the norm. But I don't see that for the next 10 or 15 years. But I think it's a great opportunity. Not so much now. Perhaps if the perfect storm and all the ingredients align, well, then as a value investor, you'd certainly entertain it.
Well, if you look at infrastructure as such, right, and this is a really good example, train stations going in, the vast amounts of house and land packages being opened up, offices going up and all that. When you look at the average investor out there, they will either jump in when that's announced, or they'll start filtering in once it's totally complete. Because they want to see tangibility, right? And usually during the construction phase, people tend to forget about these areas because another news item breaks out and they're focusing on that. So what I call the shiny syndromes, or whatever makes most noise, they adjust to that. The importance with following infrastructure is to make sure that it has actually started before you start jumping into that area.
Yeah.
But then don't leave it too late. Most people want it to be complete to see how the area is going to perform before they jump in. Address the fundamentals. Certainly make sure that the infrastructure works have actually started. And Badgerys Creek does come
That's
to
a
mind.
great example. M7, M5 in Sydney was a great example too. People jumped in when it was announced and then did nothing until it was
10,
finished.
20 years.
Yeah. And Badgery, as you say, Badgerys Creek's a great example of that as well. Watch the next run when they start turning dirt.
Yep.
All right. So, question of the month is from Zed. Zed, how you going? You've asked me not to use your last name, so happy to do so. I'll paraphrase this, Steve. I might direct this one. It's a renovation question. So Zed's asking, what should be square metre budget for doing a renovation in the Sydney market? Does this thing even exist?
No. I know there's a lot of...
It's like a formula that some people use.
Yeah, there are a lot of formulas out there. I just don't buy into that because every property is quite unique and you're looking at the outcome, not so much the square metre rate. So if I'm looking to increase cash flow, I might be doing something completely different than I'm trying to improve capital. And if work needs to be done, it needs to be done, even from a repair and maintenance point of view. There's also another formula there saying you should get three times your dollar.
Doesn't quite work.
It doesn't work for me at all. And here's actually a really good example on one of my own personal properties in Sydney.
Whereabouts?
Next door to you, you just don't know it.
Really?
No. It's in Tregear.
Okay.
And I've had that property since 98, 99, 2000, something like that. Purchased for $95,000, and it's done all right, clearly. But it's also a bit tied now, and the rent's quite low. And I made a conscious decision to keep it low rather than spend my capital where I could deploy elsewhere. Because no matter what I do to this property in today's market, there's a certain ceiling on what it will achieve for rent. So my return on investment in terms of the capital spent to improve it is just not there. It's far more economical for me and wiser to keep it in its current condition, safe, and take the lower rent and deploy capital elsewhere. So steer clear of formulas.
So how do you work it out then? Like, how do you Vic? How do you work out how much money to spend on the renovation? I guess is it for making a happier tenant, or is it a capital growth base? Probably
you have to work out what you're trying to achieve to begin with. Right? Are you trying to boost up your equity? In which case, it might be a different renovation. Are you trying to increase your cash flow, which is a different type of renovation?
Or are you trying to just keep your tenant?
Yeah, exactly right. Yeah, so give it a good.
So do you speak to your property manager and go, oh look, what's the average rent? So they go, it's $400, and you're getting $350 to say, what do I need to do to get $400 a week? Is that a good?
Yeah, that's a good starting point.
Yeah.
And then obviously you've got to make a decision. By spending, let's say you had to spend $50,000 to get your $50 a week extra.
That's a long time.
That's a lot of
return.
time. Also, a lot of downtime as well.
But do you ask the sales agent to say, if I spend 50 grand by doing this, what's going to be the...
What's it's worth?
Yeah, these are all they're smart questions that you should ask, but that doesn't come back down to the formula.
So what's our recommendation for Zed then? Just do some research. Don't worry about a square metre rate. Don't use formulas. Don't use...
Yeah, do the research on what the end result's going to be for you,
Yeah.
firstly. Secondly, is it necessary? And thirdly, who are you catering for?
So renovating just for renovating's sake, because you like doing renovations, not good reason to renovate.
No, not at all. Not at all. And we know you love renovating.
Well, I was only talking about this the other day. I've still got 1,000 kitchens and more tiles. I could probably go and tile. I don't know. I'm trying to think of something that's tiled really well. Yeah, it's just a headache now.
I could have one out of Tregear. I could help you out.
I'll sell you some tiles.
I don't want to. I'm going to help you out. Charge you for taking them out of your shed
That's
storage.
the way it works. Anyway, maybe that's what I can use this podcast for, is the eBay of renovation material.
East or Tarrant.
Anyway, we're going to have to wind up. Victor, what do we do if you need some more information about what's going on in the world today? Who can
Sure.
they contact?
If you wanted to send us a question or wanted to reach out to us directly, questions@rightpropertygroup.com.au. Go to our website. There's a whole heap of information there and lots of different topics where we've written on. Also, you can reach out on our social media.
Yeah, there's
pages.
11 pages of blogs, videos, podcasts. So there's
Is it good
wealth
stuff, or is it just you guys?
We always put out good stuff, Phil.
I can't believe you just said that. I don't know. You're involved, so it must be rubbish.
Yeah, but probably. I might go and do an assessment of it all and see. Mate, you've never asked me to write for you for the Right Property Group blog. Not that I would probably do it, but
Crickets.
obviously not that important. Anyway, no, thanks for your time, guys. Really
Thank you.
enjoyed it. And next time we get together will be, what is it, April now, so post-election.
Yes.
Is that correct?
That's correct.
Geez, that'll be interesting.
We'll probably record, but we'll probably record the week after the election. So, wow.
So
so close.
this is
It's
whilst
weird,
it's
isn't
it is a bit weird and it's a little bit sad, but I just think this is exciting times. I don't know why. I like it.
How do you keep connected with all this stuff? Just read the papers, you reckon? Make
No.
sure you know what's going on. Stay away from it.
Yeah, it depends on which paper you read. Everyone's got an agenda, right?
True.
So
Bias. Everyone's got bias,
bias, agenda,
bias.
same.
There is
But I
bias.
just think, perhaps, I'm certainly not plugging you, but I will. But like just smart property investment, like it's informed information rather than speculation. Perhaps.
I'd like to think it depends on the quality of guests I get in. But by the way, I haven't had
See
you
that?
guys.
I just gave him a compliment and he slammed me.
But talking about this, people worried about the strategy and whether it's right. You guys are happy to field some calls.
Absolutely,
and stuff like that.
100%.
Okay, all right, good. No worries. I hope you enjoyed that, everyone. Remember, we'll be back again next month for Investing Insights with the Right Property Group. We'll see you then. Bye-bye.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.